The stock market took a midday tumble at 1:30 Eastern Time after Apple stock took a turn for the worse from a Bloomberg report saying that the company would be slowing down its hiring and spending next year. Bloomberg sources note that, quote, "The decision stems from a move to be more careful during uncertain times, though it isn't a company-wide policy," said the People, who asked not to be identified because the deliberations are private. End quote. The report was enough to send Apple down 2% lower on the day, and since it's the largest company in the stock market, it also took down other stock market indices like the S&P 500 and Nasdaq with it. This isn't really just about Apple planning to slow down its hiring either. Apple is just the latest company in a long list that had been slowing down hiring for the year. Meta, formerly known as Facebook, has cut plans to hire engineers this year by 30%, according to Reuters. CEO Mark Zuckerberg reportedly told workers in a weekly employee Q&A session, audio of which was heard by Reuters, quote, "If I had to bet, I say that this might be one of the worst downturns that we've seen in recent history." End quote. Last week, Google parent Alphabet and owner of YouTube said it would slow the pace of hiring for the rest of the year, and said in a regulatory filing, quote, "Like all companies, we're not immune to economic headwinds," end quote. Other companies like Snapchat, Goldman Sachs, Twitter, and BlackRock have also cut back their hiring plans for the year. Other companies are outright cutting employees already in order to save cash, like Tesla. Elon Musk announced his intent to lay off 10% of salaried employees due to him having a, quote, "super bad feeling," end quote, about the economy and wanting to get ahead of it. Other companies that have been doing reported layoffs include TikTok, Coinbase, and Netflix. Many stock market observers are concerned that the wide hiring slowdowns and outright job cuts are a sign that companies are bracing for earnings slowdowns, which could hurt the stock market further. Barron's reported last month that already this year, quote, 67 companies in the S&P 500 have signaled that their second quarter earnings would come lower than what analysts expected. Around the same time last year, only 33 companies did so. So already, twice the number of companies from last year have signaled that earnings will come in short of analyst expectations, a 100% increase. It's clear from this that more companies are trying to lower earnings expectations for the second quarter, and second quarter earnings have just been getting started. So far, the major U.S. banks have reported for Q2, as well as a handful of other companies. But major tech companies have yet to report, including Apple, Alphabet, Meta, and others. Even if second quarter earnings are strong for many companies, the guidance they offer for future quarters might be notably lower, given that companies seem to be tightening hiring to lower their costs and prepare for less ideal economic conditions. This is a risk that the stock market is clearly concerned about, which is one of the underlying reasons why the market likely sunk following the Apple hiring slowdown news. Another problem is that even though companies have been signaling that earnings may come in below expectations, stock market analysts have not been revising their earnings estimates lower in a meaningful way. So analyst expectations going into earnings are still unrealistically high, according to some. 2 days ago, the Financial Times posted an article noting that, quote, "Analysts estimate companies listed on Wall Street's S&P 500 will report 6% year-on-year earnings growth for the second quarter, according to a survey by data providers IBES and Refinitiv. The rate of growth is forecast to rise to 11% for the third quarter of the year." End quote. Given that companies are signaling caution about the macro environment and may already be seeing signs of material slowdowns in the third quarter, the earnings estimates analysts are operating with seem unrealistic. The rate of growth rising in the third quarter just doesn't seem like it's going to happen given the hiring slowdowns and cautious attitude that companies are expressing. It seems like lower earnings might not be priced yet into stock market expectations, or at least analyst expectations, which could lead to more market downside. At the very least, it's clear that companies are being more cautious than analysts are at the moment. But what are your opinions on the hiring slowdowns and earnings forecasts? Do you agree that analyst estimates for the rest of the year are unrealistically high? And what do you think about the hiring slowdowns that major companies have been announcing? Let me know your opinion in the comments below, and be sure to subscribe to the channel for more finance content and like the video. Thanks.